Hi. It's it's the investor's psychology in equity pricing. It's a case study analysis of how emotions and their feelings influence the decision making of these individual investors. Well, basically, it's like to understand the trend, which creates some sort of impact on the emotions and feelings of individual people who invest their money in the stock markets, because basically, like, these things are ignored. That generally people just look at the market news and everything, but psychologically that has an impact on the emotions and feelings. And like, there was this research which says under pressure, like under when you experience a situation that you don't know the future outcome, like there is uncertainty, your decisions are based like well, basically it's like people of different gender, different age group, with different education background, they have different sort of perceptions about things, and they have a different level of understanding of taking risks. So people who are experienced and educated, they can take risk to a certain level, and whereas compared to people who are not into that sector or not into that sort of situation or position. So basically, like, you need to understand the human psychology, the behavior of people, to predict the patterns or the decisions they will make related to their financial investments. So these seasonal anomalies, which is quite a famous phenomena in the stock markets, like, because there are so many stock markets in the world, so many major stock markets, and every stock market got like so many different phenomena, like the Tuesday effect, the Monday effect, and we have the calendar effect, which is like in January. We have the day of the week effect, like I said, Tuesday and Monday, and in a few stock exchanges it's Friday. So I think what I did was related to the holiday effect. There was another research done on the American stock markets related to the holiday effect, like the Jewish holiday, Yom Kippur and Josh Hanana, which was like it influences the emotions and the feelings of people, because they're like religious in nature, and that reflects in the trend or in the prices, the volume traded of the stock market. So my research was also based on the religious preferences and their impact on people. Like during the holiday time, it's like it's the festive time, and they're all joyous holidays. The one which I chose, there were about 4. People experiences these feelings, and they are happy about the fact that there is a holiday and there is a festival coming soon. So I try to investigate that, how exactly that impact their decision making, and what kind of trends it would lead to eventually. So yes, there is a holiday effect available. It does affect the investors' decision making, and we can see the patterns in the stock market. But eventually, like, how can we take advantage? That is the question. Though even if you know, yes, there are trends, people do it, but how would you take advantage? How would you actually make profit out of it? You obviously have to make a portfolio. You cannot just completely rely on one share or one stock market and just keep trading. I mean, you can. There was this very famous quote, like, keep all your eggs in one basket and watch it carefully. But then I don't agree to that. No. You need to invest in the business you understand, and invest in the business you are interested in. And apart from that, you always need to make sure that you neutralize the risk. You always find the negative correlation and make a portfolio which always keep you on the even side. But at the end of the day, if you make a portfolio which always keep you on the even side, like if you make profit on one side of the stock market, on the other side, due to the portfolio thing, that will be balanced. Like, your profit will go into loss for some of the organizations. So you have to take risk. Like the rule says, higher the risk, higher the profit. And we have this efficient market hypothesis, which runs the whole concept of these stock trading. And then it always provides information at the same time, and the information which is available always get incorporated into the prices, and that reflect at the same time. So everyone, like shareholders, investors, the board of directors, or the employees, or anyone who is interested in that organization, will get access to that information at the very same time. the moment it get released, and and quickly it get incorporated into the price. Like for example, if a company says that they have registered a profit in their annual report, so that will get incorporated in the prices, and they are expected to go up, and people will invest more money if the company is doing good, if they have a good deal, or if they have a good client, a good thing, sort of source of income coming in. Whereas if the company is going through losses and they register a loss, then obviously that get incorporated as well, and the prices of their share go down eventually. And every organization in the world is just concerned about maximizing their shareholders' wealth. That's what they say. Right. It's fine. I think that's about it. It's a very interesting thing. I will not give up. I will try investigate further. I'll try to buy a few shares, and let's see how it goes. Cheers.